and then I'm going to let our panel introduce themselves. So, Bitcoin's evolution into a mainstream treasury asset has accelerated dramatically over the past year. There's now over 170 public companies now hold more than 1 million in BTC in aggregate. That represents about 5% of the total supply. So at the same time, there are a lot of analysts, and they're warning that what began as a strategic hedge may morph into a structural vulnerability. Now, reports highlight corporate Bitcoin holdings as balance sheet roulette and signal elevated credit or systemic risk if volatility or leverage kicks in. Now, this dual narrative of opportunity and danger sets the stage for a pressing question. At what juncture does corporate adoption of Bitcoin shift from innovation to systemic risk? Is there a tipping point beyond which the benefits of treasury diversification are overshadowed by the interlinkings of contagion, potential, and financial fragility? Now, we've got a great panel today, folks, and I want you to put your hands together because these folks are going to give some really good information here. Okay. So I'll stop now, and I'll open the floor so our guests can introduce themselves.
Great. Well, thanks so much for having us today. My name's Alisha Painter. I'm one of the founders of Botanix. We're building the most decentralized Bitcoin-based blockchain in the whole world, powered by native Bitcoin yield, which is what all of these corporates and institutions actually want at the end of the day.
Yeah, thanks for the introduction. My name is Michael van der Poppe. We are from Amsterdam. I'm the founder and CIO of a venture capital called MN Capital. We also have a liquid fund that is called MN Fund, and I'm the host of New Era Finance podcast.
Awesome. All right, hey guys, my name is Nandwani, and I run global business development for Binance. And obviously glad to spend some time here with Michael, Alisha, and of course, Brian.
Okay, so thank you very much. Let's actually, Michael, can I just start with you because you're in the center and I just thought I would.
Sure.
So, Michael, at what level of corporate balance sheet exposure to Bitcoin should we change from it being a manageable exposure to systemic risk exposure? Like, for example, is it when a single company holds a certain amount of its assets in Bitcoin, or is it when the industry collectively has a certain level of corporate treasuries adoption?
I think there are a few things to this entire topic, which is we have the Michael Saylor strategy that he leveraged in the essence of buying Bitcoin at the start, which is, if you're a Bitcoin believer, if you're looking for more adoption of Bitcoin, you'd rather want to have every balance sheet having Bitcoin on there to have a more decentralized adoption and more users or investors having Bitcoin. So that in essence is, I'm supportive on that. But once you start to issue debt and to raise more capital for Bitcoin, that's where the famous sort of scene from The Big Short in the restaurant where he explains the CDOs comes from. So that is what we are creating right now. We are generating a new big bubble where we either want to generate yield with a lot of risk or we want to raise debt to buy more Bitcoin, which at some point is going to collapse because we're living in a world of inflation. That's definitely true. But there is also the other side, which is deflation, that at some point the debt bubble will just collapse. And that's what we are currently acting in. And I think that the debts and the treasury companies are going to continue leveraging the thesis of Bitcoin to raise more debt. We are going to see more of them on the risk curve with not only Bitcoin, but also we've seen WorldCoin treasury companies and Sui and Solana and all those things. That is not favorable. And that is going to create another .com type of chart that is going to go up for a long time and then going down quite heavily.
Rajiv, do you want to come in there just about that? And I'd also like you, if you want to expand upon not just Bitcoin treasury companies, but like if we can sort of like move out and talk about the risk profile of, say, Ethereum treasury companies, Solana treasury companies, and we just get more and more exotic.
Yeah, I think, obviously Mikhail makes some great points here, right? But I think I'll have to respectfully disagree. I don't think the bubble is being created. I think it's burst, right? If you look at, let's remove opinion here and just look at facts. Over 60% of DATs today are under MNEV, right? They're trading at a discount. So if there was really a bubble, that would not be the case, right? There would be actual value accretion and real accretion in the premiums that retail would be paying. Right? If you look at retail, they've lost about 17 billion trying to get proxy access to Bitcoin by doing these DAT investments when they could have just gone to a decentralized spot exchange or to an actual centralized exchange. Not talking up our book, obviously, but they could have just gone straight if it was frictionless to do so. Just bought Bitcoin directly, right? So I don't look at that as treasury companies necessarily. They're almost like volatility factories, right? Where they're playing the market arbitrage game that hedge funds, that structured and that sophisticated players in the market have done over time. And this is not new to crypto, right? Like the SPAC guys did it back in the day. The equity market players did it back in the day, right? This has happened across asset classes. And I think it's just an evolution that shows that crypto is becoming an institutional asset class, right? So, I don't think that we're going to see this accumulation and then, massive big short moment. I think people are realizing that the thematic is probably over, right? And that it's going to change. I think these volatility factories are going to become more structured asset managers, right? And they're going to go to the likes of my colleagues here to actually generate yield sustainably, right? And in a sophisticated manner to generate value on the assets that they hold in their treasuries, right? And just to that point, even if we see all US corporates, right, allocate even up to 3% of their treasury, right, into Bitcoin, it won't even represent 10% of the market cap of Bitcoin buying, right? And even if they all do that, your price will adjust, right? So is it anywhere near systematic? I would say no.
Okay, so it's nowhere near systematic from yourself. Rajiv, Alisha,
Yeah, I was going to say I agree with both of you and disagree with both of you in a specific way, because I speak to companies and treasury and DATs all day long that are learning about and trying to adopt Bitcoin. And it's really interesting because a lot of these come from the TradFi world and the corporate world, and they are very sophisticated investors. And you're seeing new structures come up, you're seeing rating institutions come up, you're seeing risk curators come up that are very specific to the TradFi context and not the DeFi context. Yeah. And they're very educated. They're putting us through a lot of diligence, I can tell you. So I think it's really positive, the level of sophistication they're bringing to the fore. And I think that will shield them from a lot of the generally systemic risk that we've seen with DeFi and what we saw a few weeks ago, for example, with the bubble bursting. But on the other hand, I think there's also a lot of money being made with confusion. And there's a lot of folks coming in that may not have the knowledge and the history of, one, what Bitcoin is, how it works, how the protocol economics work of Bitcoin itself. And so I do think that there's still quite a lot of obfuscation there, and something that we, at least at Botanix, are trying to educate the market in terms of, okay, what are the basics of Bitcoin? How does it work? Why is it important? Why is decentralization still important at the end of the day? And how can you put your Bitcoin to work in a safe way? And for us, speaking about the centralization risk that could potentially come from corporate adoption, it really comes down to like a decentralized custody model or a decentralized model for how the Bitcoin is actually held, and being very clear about the level of risks that you're assuming, be it smart contract risk, be it protocol risk, be it bridging risk, just being very knowledgeable about all of these. And so it's exciting to be at the forefront of Bitcoin as it's institutionalizing and professionalizing, and we hope to, take this forward.
Can I segue, because that's very interesting what you just said there, Alisha. Can we talk a little bit about how to put your Bitcoin to work in a safe way? Can we let's focus on that for a little second. Rajiv, what would you say? Give us your view upon that. What are the risks? What are the best approaches?
I actually think I'll defer it back to our colleagues here, right? I think they're actually at the forefront of trying to extract value from what today is seen as more of a stable holding asset, right? And I say stable with obviously knowing that that's a controversial word to use for Bitcoin, right? But yeah, I'll pass it back to our colleagues here.
Yeah, okay, so can you just unpack that?
Yeah, I think the risk profile of someone who holds Bitcoin, I won't say Bitcoiner because that's a different user persona completely, but someone who holds Bitcoin, it's very different from someone who holds Ethereum or a bearer chain or maybe another much more speculative asset, right? They want to do two things with their Bitcoin. They want to be able to earn yields in a safe way from assumptions that they understand, and they want to be able to collateralize their Bitcoin. So use it as collateral to borrow stable coins or lend or trade or this other array of simple financial applications. So it's completely different. I think the world of Bitcoin finance and basically Bitcoin scaling is going to look completely different from Ethereum and DeFi Summer. It is fundamentally a little less degen, right? They are not going to be transacting with their protocol or hitting it 1,000 times a day. They're going to basically park their money there and have it work. And so what we basically built at Botanix is we built this mechanism called STBTC, whereby all of the yield that is generated is from the gas fees on the network. In Bitcoin, not affiliated with anything else. Yeah, and that basically has found massive product market fit because it is the closest thing to native Bitcoin yield you can get. Because traditionally, what you've had to do is basically bridge your Bitcoin over to Ethereum, mint WBTC, and then basically access the array of applications on Ethereum to earn yield on your WBTC or other Bitcoin derivative. But that's, if you look at Aave, that's like 0 to 1%. So very, very low. If we're able to find productive sources of Bitcoin yield, that's a $1 trillion opportunity right there.
Well, okay, so I went off on one there on that one and went down a segue. Michael, can I come back to you actually? Because right at the beginning of this discussion, you were talking about systemic risks and you were talking about breaking points. And I'd like to actually get you to maybe divulge any of your kind of ideas, the indicators that you would see about when the risk is going to lead to become systemic. Is it because of a price drop in the underlying asset that triggers a margin call? Is it the forced selling and all of those knock-on effects? Could you just describe to us that scenario?
Well, I mean, I have to agree with you on your point that we had a big sort of retail bubble in all those treasury companies that basically retail investors that were not really interested into buying Bitcoin were buying strategy, and then it was traded on a multiple of the actual value. So that's true. But I think it's not a bubble that is active right now, but the creation of all those stable coins, whether it's yield attached or risk attached to it, and on top of that, we have all the debts that are actually issuing debt to buy more of a crypto. That is the build-up of the bubble. It's the same as some of the equity companies that are artificially keeping their values higher to raise more money, to do buyback programs, to keep their assets up. So we are in a bubble. We are in a debt bubble. And if you just have a rational view to most of the charts and you don't put them on logarithmic chart, then you can just see that everything is currently at the top of the Burj Khalifa. There is no asset class at this point where you can actually generate a return from outside of crypto. I mean, commodities have just gone up massively. Today is the worst day for gold since 2013, which shows that the volatility of gold itself has gone through the roof. I think it's up 70%, and the average fall of gold is around 8 to 9% on the year.
You're seeing top signals across the field.
You saw the queue like last week
That was
in Australia, right?
Yeah.
Which blows my mind that people are still doing that.
Yeah.
But the point is, the money is going to rotate towards other assets that are still attractive to generate a return from. The very easy case, gold to Bitcoin, is easy to be made. But then outside of Bitcoin, there's the entire ecosystem that you can still get a return from. Commodities are, in the sense, the upside is done there for now, in the short term. Equities are already far off. Bonds are not really breaking the hurdle rate. So what do you have to do? Well, you go into crypto. So that's the asset class that you can still generate a return from. But if you allocate it towards crypto, you go on the risk curve, which then means that in the grand scheme of things, we are at the end stage of a way bigger cycle, which is the macro cycle, that just needs to reset at some point in time. I don't know when. It's going to go in the next few years, probably 2 to 3 years from now, but it is, yeah, it's not good. And I think the fact that gold went up 70% in 1 year is basically showing you that something is breaking.
Yeah.
Okay, Rajiv, I'm sure you want to come in on a lot of that sort of stuff, but I'd also like to, if you can come in also on, let's give us a little sort of a dissection between two different types of companies, MicroStrategy and Cantor Fitzgerald and the 21 Capital, basically, Cantor Fitzgerald and all that. Look, are the two different approaches that they have when it comes to their Bitcoin treasuries and stuff like that? Which do you think is the most prone to systemic risk, or the most prone to a crash between those two companies?
Yeah, I think so. Right before I address that, I just want to point out, I completely agree with the systemic risk of the market as a whole.
Right.
Right. I think if you look at these worries about hyperinflation, right, about yields kind of coming down in general, right, about people trying to hunt for yield in so many different markets around the world, right. If you look at every asset class, even equities is giving you a average yield of 5-6%, right, over a 30-year period, versus Bitcoin that has given you 50, right? And even if you believe Saylor and it's going to come down to 25, right, over the next 15 years, that's still significantly higher yield than you're getting in any other asset class, right? And so this hyperinflationary kind of world that you're seeing, really crypto is one of the few asset classes that you're probably going to be able to escape it from, if you even do, right? So I completely agree with that point. Now, to your point of which type of firm is more prone to systemic risk, right? I have to give a lot of credit to what Cantor is doing because they're building a true Web3 ecosystem, right? If you look at their investments into Tether, which is not recent, by the way, right? They kind of saw way ahead before Tether was cool, right? To invest in the piping and the infrastructure. It's what Binance does best, right? Like we've, over the last 8 years, invested in piping and infrastructure. We've built a portfolio of, via the family office, YZI, of 2,000 portfolio companies, primarily in that infrastructure segment of the market, right? Cantor is doing exactly that. And they're actually doing it as the backbone of the US economy, right? And the US sees the writing on the wall, right? What's the best way to export their currency and their debt, right, to new buyers? It's stablecoins, right? And I think the world is starting to wake up to that, massive trick that the US has realized over time. So I don't necessarily think that what Cantor is building is prone to deep systemic risk. Obviously, everyone is, right? Exchanges are, DEXs are, right? Projects are, DATs are, right? But that's, again, in every asset class. I don't think that's crypto specific. I think the biggest risk is when you start seeing the strategies of the world, right? So the sailors of the world realize that, this financial engineering kind of segment of the market and phase of the market is over. What's the next trick in the playbook, right? And I actually think it's going to be yield generation. I actually think it's going to be, let's start valuing these companies from the cash flow they can generate on the assets they're holding sustainably, right? And if you get to a point where Saylor, who's sitting on billions of dollars of Bitcoin, can suddenly generate 10% free cash flow, 7% free cash flow on that asset, well, suddenly, if you multiply those free cash flows by an average premium of 10x your revenue, right, or 15, 20x your revenue multiple, which is in the US, right? Suddenly, yeah, you justify the valuations, right? And the one reason why I don't believe that strategy has a deep systemic risk is I consider them to have a sovereign premium.
Right.
In the future, if a sovereign the size of the US, UK, Europe as a whole, right, or India decides that they want to buy Bitcoin in significant size, it is easier for them to buy MicroStrategy than to go to the market and buy Bitcoin outright because they're not going to be able to source supply, right? So sure, I see these type of decently run, governed companies having that sovereign premium on top, right, which actually mitigates some of that systemic risk.
Okay, Alisha, can I bring you in also just about, Michael and Rajiv have been painting a picture of like the hunt for yield, really, and about yield-generating products and stuff like that. Now, you talked about Bitcoin. Let's open the floor a little bit more and talk about Ethereum. Obviously, you get staking yield and stuff like that. I'd like to just get your opinion on Ethereum treasury companies, Ethereum-based DATs. What are your views on that?
I think there's obviously a market for Ethereum DATs as there is for, I'm a Bitcoiner, so sorry, I don't hold anything else.
That's why I asked.
Love it.
But, in this much more diverse audience, I will say, if you would like to buy an Ethereum DAT, go at it. It's really interesting. I think it's going to be, Ethereum obviously has found product market fit as, programmable money. And so it obviously makes sense for them to also develop their own DAT structures. I think it is a bit tricky once you start seeing literally every cryptocurrency build their own DAT. I think that I think creates a level of systemic risk that I don't know if the market is ready to absorb. But that's my take. But I'm a hardcore Bitcoiner, as I said.
Rajiv, can you come in on that? Because that is actually quite interesting, just that last point. But yeah, go ahead.
I think, and they're probably not going to be happy with me saying this, because I don't know if they've launched already, but the most exciting ETH DAT idea, right, that I've heard was creating an Ethereum DAT where they accumulate ETH, right? Mm-hmm. But with the yield that's generated naturally, they're going to have obviously a pot of money. Mm-hmm. And what they'll do with that is actually invest in large Web2 brands, but with the mandate to actually bring them from Web2 to Web3 using ETH layer, right? So I thought that was super fucking cool because really cool. Essentially at the end of the day, they're helping build the ETH ecosystem, right? They're driving more adoption, which will probably also then generate cash flows, which they can use to sustainably accumulate more ETH, right? And so I thought that was one of the coolest ideas I've heard, and actually a natural use case to what we were just talking about, which is forget the financial engineering, invest in an asset class that you think is going up in your treasury, generate yield from that, use cash flow to buy cash flowing businesses, right? And use those businesses to generate more adoption to the asset class that you're actually buying and create that beautiful loop, right? And I think that's what some of these guys are actually doing.
It's the most incentives alignment I've heard from.
Absolutely.
That's a smart incentive alignment. Michael, can you come in here just about like Bitcoin DATs as opposed to Ethereum DATs, and this idea that Ethereum DATs, there's a little bit more sort of, they can be a bit more productive, you can kind of work with them more, there's more, it's like you've got a big Lego set there you can build with, whereas opposed Bitcoin, maybe not so much.
Well, I think that that's not true. I think that the biggest market that is being built and designed right now, and Botanix is one of them, is Bitcoin-Fi. I think that is pretty much in the early days still, and that there is a lot of investments into the ecosystem that are going to generate that yield that everybody is looking for. And that's why having your Bitcoin, making it active, is just as sound as having Ethereum in your portfolio. It's just ultimately volatility and risk that you need to weigh out. So, I mean, if you are a believer in Ethereum or in Bitcoin or in both, probably we're going to have ETFs that have both in them, like a basket. Yeah. It's fine, as long as you don't go onto the risk curve even more by issuing debt. So the thing is that if we have Ethereum DATs, and I think the recent lift of Ethereum in the summer with the ETF inflow shows that the impact of those buy pressure on ETH is way higher than on Bitcoin. So ultimately, if that is going to take off some more, and Tom Lee is a big example of by doing the Ethereum treasury company, it's going to generate a higher upside for the asset itself, and therefore more volatility, and therefore more risk. Yeah. And you can stake your ETH as well and get the return out of it. But on the other hand, with Bitcoin, you can also generate yield through making it more active. So it's the same for me, as long as you don't go heavier on the risk curve by issuing debt.
Right, okay. I suppose when you move further out the risk curve to more sort of exotic altcoins, then you're going to have like more volatility, more movement up and more movement down in terms of that. Like, what is the kind of the value proposition really of having maybe a Solana DAT or any of the other more exotic? Like, let's go way out there and let's just talk about value propositions about those. Anyway, Rajiv, do you have any ideas about that?
Yeah, absolutely. I think again, as corporate adoption increases, right? Because it's interesting. I think crypto is one of the few, actually maybe the only asset class in the history of man that started retail before it became institutional, right? And I mean, someone tell me another one that was the case, right? But if you look at corporate adoption, building in cryptocurrencies, and let's say even the top 10, the top 20, I actually think structurally, right? Although, yes, you might see times where even gold volatility goes up, right? But I think structurally, the volatility kind of market structure of this asset class is probably going to come down, right? Like with the corrections, with the cleansing outs, with just the evolution and institutionalization of the space, I think vol comes down, right? So I do think that obviously, right, I think actually there's like 200 plus stats already that exist across almost every one of the top 25 tokens, right? So it's here, it's not in the future, it's not coming, it exists, right? But I think because of that, you actually get lowered down over time, right? You get lower down the vol curve, right? And what that then allows people to do is treat this asset class as they would normal assets that they would hold in their treasury anyway, right? You remember a time in the 90s where oil, right, was not even an asset class, right? Like there was no ETFs and there was no like structured products on oil. The same thing was for emerging markets, right? You only got emerging markets as a part of your portfolio diversification, right? When there were indices, when there were ETFs, when there were structured products for it. We're getting to that point in crypto now where it's starting to be looked at, regardless of which crypto it is, right? But crypto as a whole is starting to be looked at as just a natural addition to your portfolio. Ask the big wealth managers, right? And they'll tell you every one of our even basic plans, right, includes 1% allocation to the ETF, right? That's why the BlackRock ETF was the fastest ETF to ever generate, that amount of value in its history, right? So I think regardless of where in that token curve you are, right, at some point the industry is all going the same route. And I think that's good for the space.
It does depend on risk appetite. Michael, can you come in there about Larry Fink? Give the advice about like 2 to 5% of allocation to crypto in corporate portfolios. Like, where do you stand on that? Because you're the kind of guy that I know would like have his portfolio very much well balanced. So I'd like your advice on that.
My personal portfolio is not as well balanced as it should be, I guess.
Okay.
The thing is that I think it's fair to say, as I come back to the same point, is that the asset class with the best upside, and we just had Julien talking about the yearly returns on crypto, by far is crypto. So Bitcoin has been having an annualized return of like 110% or so. It's gonna come down because the asset class is way bigger and then the vol goes down. But if we look at the structure of a corporate portfolio, then it's almost a must to have those assets in your portfolio because you're stupid to not have it in there. If the competition has it, then it's almost game theory that you need to have it in there as well. The thing is, though, that if we have all those corporate portfolios, they just should be having Bitcoin and ETH in there, maybe a little bit of Solana. There is 0 point to have an Aptos DAT or an Algorand DAT. The only reason that that is being created is to pump the token or to artificially pump the equity of the asset itself, and then to generate more rounds or more value for the company, and then just create the flywheel. It's enough to have Bitcoin and ETH alone, and I think that's where we need to come from. And in terms of treasuries and balance sheets, I think it's a marketing tool that companies are using it to become a DAT, but essentially you want to have a proper corporate using the balance sheet to just have gold, to have Bitcoin, to have government bonds, to have a basket of things so they can continue to grow as a company and not to make revenue more out of crypto, but actually to fuel the company even more to continue expanding.
Can I just ask you one more question before? Actually, Alisha, I want to ask you a question as well. I know we've only got 3 minutes, but you know the way the Cambrian radiation or Cambrian explosion, there was a plethora of life just sort of burst on the planet, but then that led to a bottleneck. And if there is a bottleneck in crypto where only a few assets get through, do you only see Bitcoin and Ethereum getting through that bottleneck? Say fast forward like 5 or 10 years.
No, I mean, Bitcoin is going to last, Ethereum is going to last, and the ecosystem is way bigger. However, everybody is like pissed off because of the token performance. But I think the project, what they built, and the token performance are two different things.
Right.
So the ecosystem is way bigger. It's going to be modular. I mean, the BNB token is doing great, but also Aave is doing great as a DeFi protocol.
So, would you rather see more focus then, less on token performance and more on what actually people are building?
Yes, and the token performance will come in.
So I've been chatting on stages like this here for the last, I'd say, about 6 years. And we haven't really matured to the point where we're like really talking about actual products. It was actually stealing what Fami said actually in the last, if you were here for the last panel. How do you feel about that? Like that we're still kind of chatting about the same stuff?
Different use case since then. Since the last year, we have stablecoins and DeFi, and the best tokens that have been performing has been Hype, for instance. BNB, Hype, they
Which is, by the way, the oldest use case for.
Yeah, it's just it's been there since I
packaged
started.
differently.
Yeah.
No, I know what you mean.
I mean,
Still talking about the same stuff. Alisha, can I talk to you about Jack Dorsey, obviously, and that video that he posted? Did you see it like during the week? We went to a cafe and he bought something in Bitcoin and he posted like Bitcoin is not crypto and
it's money. Yes.
You're a real Bitcoin maxi, aren't you? You know, just getting that vibe. So what do you think? What do you think in terms of like what kind of statement was he making there?
Yeah, I think just to respond to a little bit of your previous question, if that's okay. We've been talking a lot about, Bitcoin, Ethereum, all of these other crypto assets that companies are absorbing within as part of their balance sheet strategy, as part of their DAT strategy, treasury strategy. But yeah, I talk to liquid funds and DATs all day long. I think there's not a single liquid fund that's outperformed Bitcoin over the past 5 years consistently. And just Bitcoin, by the way, not Ethereum, just Bitcoin. And so I think when you talk about that Cambrian explosion, right, I think Bitcoin, to me, is truly the one that survives and subsists. And obviously, Ethereum has found product market fit as programmable money. But as more and more scaling solutions like what Jack Dorsey is working on. I mean, Arc Labs just came out today, which is a really interesting other way to build on Bitcoin. Obviously, Botanix, we're building an entire Bitcoin finance ecosystem on Bitcoin. I think with more and more of this, I think it's, and as Bitcoin Fi matures, because to your point, it's so nascent, I don't think it's a thing yet. But as it matures more and more, I think it is going to be the one that breaks through. Obviously, there's going to be room for other tokens and other projects. Actually, Aave is one of the few tokens that I hold. I love Aave because they actually produce revenue. There's, I think, less than 100 companies that produce over $1 million of revenue a month in crypto, which is a crazy statistic.
Right. Yeah, it is actually Aave. Yeah.
Yeah, but I mean, I think fundamentally, if you think about the origins or the progenitors of Bitcoin as eCash back in the 90s, it was meant to be peer-to-peer money, and I think the financialization of Bitcoin is very mutually synergistic with payments, and building that out, and so that's what we're excited about.
Well, isn't the second sentence in Satoshi's white paper something about this is peer-to-peer cash and stuff like that? Yes. So we're going back to those roots again, potentially.
Yes, and corporate adoption is an essential part of that journey.
Thank you very much for coming to the Bitcoin Maxi event that we're hosting today. So, guys, does anybody else want to have anything to say? Because we have run out of time. But
I think if I was to leave everyone here with a couple of insights, right? I think the first is be a user yourself and stay as close to the user as possible to just understand the practical use cases, right, and the pain points. And the second is just keep building stuff that fixes those pain points and follows those practical use cases, right? And the final one is, and this is definitely not financial advice, I think we've hit a point in this industry where holding none is riskier than holding some, right? And I think that's purely from a mathematical perspective. It's purely from a risk-return perspective. And so be curious and interested enough to at least try to hold some to your own financial means, right? And I think you'll find that actually you can then focus on building as well.
Yeah, well, I think in traditional finance circles, that message, holding some is riskier than holding none, is actually starting to permeate. Michael, do you just want to just say anything before we all just close the gig for? No, well, there's another panel coming up. Yeah, Michael, do you want to say something quick?
I mean, to be honest, I think keep on building, keep on stacking sets. Erase the entire 4-year cycle out of your brain. It doesn't exist anymore. We're just getting started. I mean, I've been listening to Julien, so I'm full-blown bull at this point. So yeah, and just keep on going. We're still early.
Keep on stacking sats, people. Okay, thank you very much. Round of applause for the audience.
Awesome.